lot of headlines out there about, Pabst being sold to the Russians. It wasn't sold to the Russians. It was sold to a private equity firm and a guy named Eugene Kasper. But that was, 1 year ago. And as you saw in the video just a moment ago, just a flurry of deal activity in the last 12 months. And all of it sort of culminating a couple weeks ago with the billion-dollar purchase of Ballast Point, the largest craft beer deal ever. So this is clearly an area of the business that is critical to discuss. We'd be doing the entire industry a disservice if we didn't address some of the various exit strategies that are available to craft brewers. So in addition to a full hour of financial planning workshops that we've set up later after the break, we wanted to bring a few of those experts up on stage, some folks from the financial community, to discuss not only the latest deal activity, but some of the considerations that craft brewers have when they're looking to take that next step. So we've got three incredibly knowledgeable folks coming up: Mike McCann from Fane, Rocky Fiore from Prairie Capital, and Ryan Lake from First Beverage Group. Each of them are going to present separately for about 10 minutes or so, and then rejoin me on the couch here for a brief Q&A. And first up is Mike from Fane.
Thanks, Chris.
Thanks, Mike.
Well, and thank you, Wynn, for that great talk. I mean, that's really very interesting to see the life cycle of a brewer. And I'm going to touch on some of the themes that she touched on also. When you're starting a company, when you're planning out a potential sale, there are things you need to think of up front. And I'm just going to go through a few of these very quickly because I do want to save a lot of time for our panel discussion. But some very simple ideas. Tax planning. Tax planning is all about paying the lowest possible tax at the latest possible date. Sometimes you can't eliminate tax, but you can defer them. And you have to realize that time is your ally. I mean, in so much of what I'm going to talk about, time is your ally. Now is the time to do things. It's much easier. You have many more options to sell a company that's a pass-through entity. In some situations, it just won't work, but if you've set yourself up as an LLC, that's probably helpful to you. If you've set yourself up as a corporation, you can still make an S election to get that pass-through taxation. That way, when you sell out at some point in the future, it's more convenient to do an asset sale. Often the buyer is going to want that asset deal, and if you're a pass-through entity, you can accommodate that at a much lower tax cost than if you're a C Corp. So, but the S election is only good if it's been in place for a number of years. So you can't do it on the eve of a sale. You have to do it years in advance. So again, something you need to think about now. Also, I know we're going to get into some succession planning maybe later in the presentation in the day, but if you want to gift to your children or for other estate planning purposes, time is a huge issue. You need time to do that. You can take discounts for minority interest, for lack of transferability. These discounts can be up to 40 or 50% of the value of what you're gifting. So you can significantly reduce estate taxes and gift tax if you do this, but you can't do it again on the eve of a transaction. You can have a little window at that point, but not much. Corporate structure. This is something that Wynn touched on, and I think she's, and Odell's is maybe the exception. She cleaned up her ownership structure early on in the process. She had some friends and family that had invested in the company, and they took those people out early on in the process. You'd be amazed how many times we get involved in a deal, and it's not clear who even owns it. They did a friends and family round, and the documentation wasn't very good because there wasn't much money at the time. And so, or they've made promises to certain employees that we'll take care of you, but it's not defined or not defined well. And guess what? Getting taken care of, your employee may have a very different idea about what being taken care of means than you do. So take the time now to figure out your ownership structure. If there's loose ends, if there's incomplete documentation, get it done now. It's simpler to do it now than on the eve of a transaction. Similarly, as I said, with employees, if you've got some kind of equity incentive plan, make sure it's well documented. Make sure everybody understands what they're getting. Make sure it makes sense. Intellectual property. As Wynn noted, oftentimes you don't have a lot of cash when you're starting your operations. And with the number of brands that people are now producing, seasonals and everything else, it can be very expensive to trademark all of your brands. But at the end of the day, if you're going to do an exit strategy, that's what you're selling. You're selling your brand. And so you've got to make a conscious decision. Do I want to spend the money to get federally registered trademarks on my brands? Maybe not all of them, but certainly your primary ones. And you really don't have much to sell if you haven't protected your brands, if you haven't protected your intellectual property. So you need good counsel in this area, and you need to take affirmative steps, and you need to do it early. You want to get that federally registered trademark as soon as possible. It gives you presumptive rights across the United States. Also, trademarks, just because you get a mark federally registered, doesn't mean that it's all that valuable. There's so many marks out there that are incredibly generic. A generic name, IPA, you can't trademark IPA. You need to have an interesting name. So when you're thinking of names, consult your intellectual property counsel to see how strong that trademark's going to be, how well you can protect that name, because that's going to give you value when you try to sell your company. Financial reporting. You need timely and accurate financial reporting. You don't necessarily need audited financials, but you need to have good financials. They have to be in accordance with generally accepted accounting principles. And you have to deal with related party transactions. We see a lot of situations where people either lease the real estate from themselves at below or sometimes above market rates. There are various side deals with family members or related parties that skew your financial results. And it's very difficult when you're trying to sell a company to say, don't believe our financials because I'm paying my brother-in-law, but that doesn't really count, and you'll be able to do this and that. You can have those conversations, but it's much better to have clean financials that accurately state your financial position. Environmental issues. If you're going to buy real estate, or sometimes even if you're going to lease, get phase ones. Test that real estate. You just don't want to be in a position when you're selling your company to have some environmental bogey out there that's going to foul up your deal. Address it when you move into a property. Just because there's some contamination doesn't mean you can't use it or can't buy it, but understand the situation and deal with it as best you can so you know what's going to happen when you try to sell your company, and it's not a surprise to a buyer to find some environmental issue on your property. Also permitting. Wastewater permits are a big deal in the brewing industry. You need to understand what permits are necessary. You need to make sure you're in compliance with them. You don't want to be in a situation where you're grandfathered, where if you do a transaction, the buyer isn't going to be able to take advantage of some grandfathering provision you have in a permitting scheme. As Wynn noted, distribution. You need to choose your distributors wisely. And that's tough when you don't have a lot of leverage, when you're a small brewer. But as you grow, these distributors are going to be very important, and it's very difficult to change distributors, as you know. And this is going to be an important component to a potential buyer. Also, your distributor footprint. Do you have a distributor footprint that's going to be conducive to a particular buyer? Oftentimes, who you can sell to is limited by who you've chosen as a distributor network. Regulatory. Obviously, alcohol is a regulated industry, and you have to understand the limits, especially if you're operating under some small or craft brewing distinction within the licensing scheme. And you need to understand what's going to happen to your license as you increase production, and what would happen if a larger producer purchased your brewery. Would that change your license? Would that be an impediment to getting a deal done? Often there's not much you can do about this, but you do need to understand it. So again, I want to keep this short so we have plenty of time for a panel discussion. So I'll turn it over to Rocky.
Going forward, the big green one?
Green button.
Okay.
They might be getting queued up.
Okay.
There we go.
Okay, all set. So I'm Rocky Fiore. I'm with Prairie Capital Advisors. I'm happy to be here today. I'm from Chicago, so this time of the year, it's always a pleasure to come out to sunny San Diego. So we're going to talk about ESOPs today. It's not going to be a very deep discussion. We only have about 10 minutes to review it. My primary purpose is to maybe provide some information, some exposure, whet the appetite, if you will. Just quick show of hands. How many people are familiar with ESOPs? Okay, well, that's good. So we got a good starting point. So a little bit about Prairie Capital's business. We have 35 professionals. Our main office is in Chicago. And then you could see on our geographic footprint here some of our other offices. We do work across the country. We're in virtually clients in all lower 48 states. But on the right-hand side of this particular chart, you can see the three primary service offerings we have. And I just want to make it clear, I don't begrudge anybody whose idea is to just sell their brewery or their business outright. The opportunity here is to maybe share with you that there are other paths if that's something you would like to do. So it's more about just education and information, and that should allow you to make the best decision possible. Our ESOP advisory bucket, the service line you see in the middle there, represents about anywhere between 50 to 75% of our revenue as a business. We've done hundreds and hundreds of transactions. We were privileged enough to participate in the Odell transaction, and that's a very exciting one. Odell is a phenomenal business. We're very proud to have participated in that transaction. And so, you know, the objective here is to see and help educate others to see if there's additional opportunity. So really quick, just what is an ESOP? The first piece of it here is it's an ownership transition tool. At the end of the day, it's an opportunity to take advantage of liquidating your business in a controlled fashion if that's something you're interested in doing. Where you don't have to sell the business outright, you can do it in pieces. Whether that's fractional, less than 50% sale, or something greater than 50%, even all the way up to 100%. Another thing to keep in mind, it's an employee retirement plan benefit. It's a qualified retirement plan benefit. It's governed by ERISA and the Department of Labor, so it's high in terms of its regulatory requirements. It's another thing to keep in mind. But the employees ultimately are the beneficiaries of the ESOP. They are going to get shares in the sponsoring ESOP company. And then the third thing to think about is it's a tax-efficient way of selling the business. So the federal government has created certain legislation that is provided for certain tax benefits, not only to the corporation, but also to the selling shareholders in the business. So some things to consider when structuring an ESOP transaction: size of the transaction, again, minority versus control, how large of a block of stock are sellers interested in selling, and who, if there's multiple sellers, are interested in selling. Financing for the transaction. So this is a self-funded transaction. So determining where the money is going to come from is one critical component. ESOP features, this is structuring. This really comes down to what type of benefit you'd like to convey to your employee participants. How large of a benefit, how small of a benefit. So there's certain designs of the plan you can do to determine what the benefit to the employees are going to be. Other synthetic equity plans, warrants, things like that kind of muddy up the water here and make things a little more complex. We're going to pass through that, but I'd be happy to talk to you all later in the day if that's something you're interested in learning about. And then again, tax treatment. Mike talked about how you're set up as a corporation, but in an context of an ESOP, you'll have to be an S corporation or a C corporation, and how you set that up will determine the tax benefits that may be enjoyed by the company. And then a 1042 election is an individual tax benefit that's available to shareholders. So where does the money come from to finance a transaction? On the upper left-hand corner of the screen here, you see senior bank debt. So the most traditional or likely form of financing is going to come from a bank. So it's good to have good banking relationships or to find ESOP-savvy lenders. Seller note financing, this is when shareholders themselves are going to finance the transaction in whole or in part, and determining, what the appropriate rate of return on that seller note is going to be is, again, part of the structuring exercise. You can see some other things in the middle here, mezzanine financing or junior subordinate debt financing. Those are less likely in the context of an ESOP transaction, but we still see them. And then all the way at the bottom, if the company is cash rich, that can be used as a funding mechanism. And also we've seen certain situations, again, creating a more complex transaction, but where employees themselves are investing their own money in the transaction. Okay, what makes a good ESOP candidate? This is for any business. It's not just a craft brewing business, but it's for any business. It's something to keep in mind because, again, it's a self-funded transaction. The business should be profitable and should be growing. It should have a strong management team. This is really key if the selling shareholders happen to be interested in exiting the business, either now or in the future. So setting up a good succession plan is important. The desire to stay independent. We heard that from Wynn. That's something we hear all the time. The idea that you can't fathom a third party owning the business and changing the culture and changing the things that have become so important and why you've become the business that you are today. Staying independent is critical. Has the debt capacity. The business has to be in some way or another financed to complete the transaction, and so having the ability to generate that financing is important. Owners interested in generating tax-favored liquidity, again, Mike mentioned it. If it's something you're interested in terms of total tax avoidance, there's an opportunity to potentially do that through an ESOP transaction. And then you want to benefit the employees. You want to create an opportunity for the employees to participate and share in the success of the business. That's a primary motivation for people that go down the ESOP path. In terms of the process, really early on, valuation and feasibility, who performs it. So there's going to be an ESOP team and a corporate team. And either side of the table can perform a valuation, and either side can perform the feasibility study. We typically see the sellers engage directly, or the corporation engage directly with the team that does the valuation and the analysis. Value expectations, and this is going to be a key factor, obviously, in deciding an ESOP. How do you determine value? Who does it? So we're going to talk about that in just a second. It takes 30 to 60 days to get started, and I think through that process you can have enough information to make a decision on whether or not you'd be prepared to move forward. So valuation, really quickly. The value of your business is worth what anybody's willing to pay for it, right? But what happens when you're not out in the market auctioning the business and determining what somebody's willing to pay for the business? So there's some fundamental approaches, and these are what we're using to look at the value of a business in the context of an ESOP. Discounted cash flow, guideline public company method, those are two very common ones. Guideline transactions, this would play a role. The craft brewing space is very hot right now. There's a lot of precedent transactions. Multiples are very rich, so we take a look at that information and see at what level it can be applied to the context of an ESOP transaction. This particular slide, the thing to point out is there's a corporate team and an ESOP team. This is a negotiated transaction. There's parties on both sides of the table. It's an arm's length transaction. So it's not a way to just design some type of scheme. It's above board. There's independent parties that are representing the participants themselves, and so there's fiduciaries and those kind of things that are involved. So it's important that you button things up and that you do have an independent third-party arm's length transaction. So this is an interesting slide. This is my last slide. I just want to point out these are some of the great names that are ESOP companies that have chosen to go down the path of being an ESOP versus selling outright. Doesn't mean you can't sell outright. I want to make that point. You can become an ESOP company and you can still choose to sell to a third party at some time down the road. The benefit, obviously, in that transaction is everybody participates. Everybody enjoys the final sale price to a third party. But biggest things, 5 reasons. I recently wrote an article on this. Cultural familiarity, the idea that your employees have a culture, they've bought into the culture, they're signed on to what the brewery has become. That's an important factor. Independence, the desire to not be sold to a third party. Controlled liquidity, saying, hey, I wouldn't mind creating some liquidity, making some diversification within my own asset base, but not selling or losing control of my business. That could be an important factor. Strong market environment. Pricing is very good for brewers these days. There's a lot of interest. You may be getting knocks on your door, calls on a phone with people saying, I've got expressed interest in your company. Would you be interested in selling? So again, there's other things that could potentially be driving a sale. Just knowing what alternatives are there are really important. And an employee attraction and retention is really key. The business is successful in part because of all the employees that come to work every day, work very hard, and do their job. So providing them with a benefit helps to retain those employees. It also helps to attract new employees. And we all know when you're starting a business or when you're growing a business, it's very disruptive to have good quality people walk out the door. And so this creates one more retention mechanism for those individuals to feel that they're tied to the company and they're sharing in the growth of the company. So that's my presentation. I'm going to pass it on now.
Hi, for those I haven't met, I'm Ryan Lake. I work with First Beverage Group. We're a financial services firm. We work only with beverage companies, and we've had the honor of working with 6 different craft brewers on M&A transactions to either strategics, companies that own breweries, or financial buyers, private equity firms, family offices. We also do consulting for craft breweries and a few dozen consulting projects. And I'm talking today about the M&A environment, so talking about, like I said, strategic and financial transactions, and obviously there's been a lot recently. I could summarize my slide in 3 points. There's been a lot of deals at very high valuations, and there are more coming. But it's obviously more complex than that. So where we are, obviously there's been a lot of deals lately. I'm focusing just on non-ESOP, non-IPO transactions. There was a smattering of deals from 2008 to 2013. And then obviously 2014 and 15 have both been record deal years in terms of number of deals and in terms of the total transaction value that was achieved. 2015 alone, there was, and this state especially was interesting, there were very few California deals until 2015. And then suddenly, for whatever reason, this year, there's been more total transaction value in California than the rest of the country combined. So it's been an incredibly hot deal year and 2 years in a row for craft beer M&A. Very high multiples paid, a lot of deals in total. But you have to look at this also in context. The global M&A environment for all industries is also having a record year in 2015. So there are certainly certain reasons why craft beer is hot, but you have to look at that this is also happening in context of a general upward trend in M&A globally. So obviously current valuation trends, everyone wants to know what their neighbor is getting paid for their house. We're all curious. And I'm looking first multiples of EBITDA, which is earnings before interest, depreciation, and amortization. It's a fairly standard financial metric to measure cash flow that's somewhat controlled. If you look at 2007 to 2013, multiples were generally 6 to 12 times. There was a few outliers below and above that, but that was kind of the normal range for craft beer transactions. 2014, it increased significantly. 10 to 15 was more or less the normal range. 2015, it increased almost exponentially. Obviously, the top end of that last bar is skewed by 2 large transactions in this state between Ballast Point and Lagunitas. And I have a few reasons why I think those deal comps are more maybe anomalies, which we may get into later. But nonetheless, 12 to 25 times EBITDA, maybe 30 on the high end, is a pretty exceptionally high valuation range. To give you an idea of context, over this entire span from 2007 to 2015, the median craft beer multiple is right around 12 to 12 and a half times. And the median multiple for all beer transactions globally, major brewers, was probably around 13 times. So this last year has certainly seen a pretty significant increase above the median. Similar trend with revenue. I'll go in detail here to save some time, but a huge jump in revenue multiples this year and last year, and then price per barrel, an even larger jump, partly driven by the fact that every barrel is not equal. Some barrels are more profitable than others. If you're Ballast Point, your barrel is very profitable. We all saw the details on that. So obviously that skews the barrel multiple pretty high. So what's driving these high valuations? First of all, it's just craft beer continues to grow. It continues to grow every year, even on larger bases, which is pretty tough to do. It depends how you define it. Obviously, if you're going to add Blue Moon and Shock Top into that mix, it's going to take the growth down a little bit. But no matter how you define it, the category continues to grow, which is pretty remarkable. There are strong margins in craft beer. It's not normal in a consumer product space to be small or mid-sized and have 40 to 50% gross margins, 20 to 30% EBITDA margins. That's just not normal. So that attracts a lot of investor interest. There's a relative scarcity of assets. And this may sound a little strange at first, given that we heard yesterday there's 4,144 breweries now, which I'm sure is 2 more by today. But there's a relative scarcity of high-quality, scalable or scaled craft beer assets with good growth and good margins. And so the brands and the breweries that have those sort of qualities are getting the highest valuations. So what gets you a high valuation? What are buyers looking for? I'm kind of going to 3 sets here. There's basically strategic buyers, those who already own a brewery, the financial world, private equity, family offices, and then there's a middle bucket that all buyers are looking for. Obviously, the middle bucket's pretty simple. Growth, high margins, quality product, good branding, excess capacity are important to everyone. Strategics looking for a few different things. They're more focused on things like distribution alignment, portfolio fit. Financial buyers are more focused on bottom line profitability, on near-term CapEx requirements. But they all want certain similar things. And then where are we headed is everyone's big question, and I don't know the answer, but we can at least kind of go through what we know and what we don't know. What we do know is that there will be more deals. Obviously there are more deals coming next year. I don't know when the deal furor stops, but there's a lot more deals coming for the medium term at least. Craft is still a very attractive category. It's still growing. It's getting more competition within the category, but the category is still growing. So there's a lot of interest from investors and from strategic buyers. There are still at the moment more buyers than sellers, but that may be changing, and we're going to go through that in the next slide. So what we don't know is can the growth momentum be maintained? This year until about June, it looked like craft was growing faster than last year, and since then it looks like it slowed down a little bit. So I don't know what the end of the year holds. But if craft can maintain that growth, it'll obviously keep the valuations high and keep the buyers interested. How will the buyer pool change? One big question is when are the big strategic buyers between Anheuser-Busch, Miller Coors, Heineken, Constellation, the foreign beer buyers, when are they going to get their fill of acquisitions? Because once those get their fill, which could be 2 or 3, it could be 5, could be 10, 20 different acquisitions each, and once those buyers are effectively out of the market, the financial buyers won't have to pay such high multiples to compete with those bidders. How will the increased competition affect individual breweries' growth and margins? We're already seeing everyone's having to spend more money on sales and marketing. Becoming a new kind of fact of life. You have to spend more on salespeople and on general marketing spend, and that's going to affect margins. If you haven't seen pricing wars yet, and I hope we don't, but that could also affect things. And then how will consumers being more and more aware of the acquisition environment change how they perceive craft brewers? We already see the emergence of forums on Beer Advocate asking who's going to sell next. So it's interesting it's kind of bled over into the consumer space. And then how will the macro factors affect this environment? Like I said, nothing exists in a vacuum, and we're living in an age of very cheap debt. We're living in an age of pretty good disposable income for craft beer's core consumer, pretty low unemployment for that consumer. So if those things change, no one knows how that's going to change the deal environment. So again, a lot of deals have happened, the high valuations, there are more deals coming, but there are a bunch of unknowns.
Thank you for blowing through that so we could chat. Did you guys catch all that? If not, we will, I promise, make all the presentations available afterwards. So I know we get that question every year, when will the slides be available? They will be emailed to you. So for those of you who might have missed Ryan's talk just now.
I go too fast?
Yeah.
Sorry.
But, you brought up a lot of good points, and one of the questions that I had written down and you addressed on your slide was, what's driving the multiples up? I mean, clearly these things have taken a life of their own. And yes, the category is growing. Yes, there's, a lot of new breweries entering the space. But when you see a deal like Ballast Point at $3,500 a barrel, it really kind of makes you stop and question, how it got to this point. Like, how did the multiples get so high?
Yeah, I mean, I think the Ballast Point Lagunitas deals are a bit of an anomaly. I think, in Lagunitas' case, Heineken clearly sees that as a global craft brand. I don't know how many global craft brands there can be. And then, we didn't work on those deals, so I'm saying there's from an outsider's perspective. But on Ballast Point, I mean, the margins were incredible. The growth was incredible. Very few breweries can maintain those two sort of metrics with their size.
Rocky, will we ever see that kind of a multiple in an ESOP, or are they a little bit more modest?
I think in the context of an ESOP transaction, it's going to be a little more modest. The idea that the ESOP can pay up to a fair market value for the company, but keep in mind that the conglomerates that are buying the craft brewers are getting a lot of synergies out of the transaction, so they can pay significant price relative to the ESOP. So the ESOP price is going to be more akin to a financial buyer, like private equity, let's say, but it won't be that of the $3,500 barrel for Ballast Point.
Right. So, since we're kind of talking about Ballast Point a bit, how do you guys kind of want to go down the line here? And, I'll start with you, Mike. When a deal like that occurs, how does that change the conversation that people are starting to have or are already having with potential buyers? Because a seller, sees a price, sees a valuation like that. Do they stop and reconsider, what they're worth? And does that change the conversation at all?
Well, I think it does, and I think lots of things can change those conversations. I mean, when we had the recession hit, I think sellers continued to view their business was worth what it was worth 2 years before the recession. And of course, buyers said, no, it was worth that 2 years ago, but it's not worth that today. So you had a real disconnect between buyers and sellers, and there's a real downturn in the M&A activity. Now, in this scenario, where you've got somebody paying an extraordinary multiple, obviously sellers are thinking, my brewery's as good as Ballast Point, why shouldn't I get that multiple? But I do think, as Ryan said, it's a bit of an outlier, because I don't think many breweries can replicate that margin and that growth rate together. And so I don't think it's going to be the model for every other deal that comes down the road, but it will have an impact, I think, of inflating prices. It just puts that upward pressure on both buyers and sellers as to what they view the value of the asset.
So how long do you think that lasts, Ryan, that upward pressure?
And that's anyone's guess. I mean, it has made our life a little tougher. We have a lot of clients now, potential clients, that suddenly see that price and they want to get that.
Yeah, right.
Which I understand.
Right. So let's talk about just the impact that these deals are having on the landscape, more broadly. With so much money flowing into the space, what is that doing to the business? How is it changing the actual business?
I mean, I think certainly you're seeing increased investment in not only capacity, but also sales and marketing. It's a little bit of feeding frenzy right now for salespeople especially, and turnover there is high. Everyone's kind of feeling the pressure to reinvest in your home markets and your outer markets. Part of that is by outside money coming in.
Right. And do you guys feel that it's intensifying the competition, even more than that we've already seen?
I think it's a little bit of a rising tide lifts all boats. And I think one of the things to be thinking about is everybody's scrambling now. The traditional American lager has been declining, and so there's a mad rush to buy good, strong craft brew brands, and nobody wants to be left behind. At least the large beer companies, and so we've just seen a lot of money be thrown at it. And Ballast Point is very intriguing. The pricing there is interesting to analyze. But I don't know that you're going to see a lot at that price going forward. We've seen a very large range, and we see the EBITDA schedule that you put up. There's a very wide range. Anybody can fall on any end of that spectrum, but I would think Ballast Point is at the very high end of that, and we probably won't see something like that again.
Well, and as Wynn pointed out in her talk, Odell's didn't do a lot of capital expansion on the come. I mean, they did those capital expansions when it was necessary. And I think if some of these brewers see the multiple that was paid in Ballast Point and realize that they need the growth to do that, it may drive them to think, we need to make some capital expansions, we need to plan for the future, and that's a bit of a gamble. And so do we finance that ourselves? Do we take some private equity money to help us do that expansion and reduce our risk a little bit that way? I think we may see some of that going forward.
Right. How about just the flow of money into the space and how it's changing how these businesses operate, independently or individually rather. When you have a lot of money to play with, that changes your thought process and changes, maybe your distribution strategy or the types of brands you're going to introduce. And there's a different set of criteria for assessing your business long term. So, Brian, maybe some of your clients that you've worked with after a deal, what's changed in their businesses?
I think it's early to say. Most of our deals have been pretty recent. And so far they're all very happy with how they've turned out, but long term will be the real indicator of how these things play out. Certainly there is more resources to work with immediately, and it's a little bit being a kid in the candy store, I think, for the first few months at least.
Right. It seems like it would be a little bit of a risk too to kind of not go from not having that capital to all of a sudden having a financial partner that can make all your wildest dreams come true, and that's got to be something that you pay attention to as an operator, I would imagine.
Yeah, I think you'd have to. It's hard to change your mindset overnight from bootstrapping it to all of a sudden being flush with any capital project is readily available.
Right.
Well, and it's also very different. When you own your own company, you make all the decisions, you can manage it in a certain way. When you've got a financial partner, you've got a very different way of managing your business, and some owners have a very difficult time making that transition. They can't come to grips with the fact that they have a financial partner and they need to be accountable to that financial party and how they manage the business.
Right. So I don't know if we had any audience questions come in or not. Regardless, these guys will be around all day, so definitely pick their brains, at the various networking breaks and at lunch. But Jane, if there's any questions that we had, let's get to them now, because I can see we're already running over time. So I do want to. It's my goal to get audience questions in today.
Yes. Hi, guys. So one of the questions that was asked was, what does the whole panel, think about craft breweries looking at an IPO or going public?
Well, with the changes that have been made in the securities laws, it's tougher to be a small public company these days. And I think if you were of a significant size, a multi-billion-dollar company, being a public company makes sense. But the expense and challenges of being a public company, the disclosure obligations for a small issuer. We've seen more small companies go private than go public, because it really, the landscape is not conducive to being a small public company. The expenses and the burdens can be overwhelming. So I think IPOs are a viable option, but I really think you need a certain scale. And really, the Ballast Point, if they had gone public, that would have been a small public offering. It would not have been a large public offering So I think if you're a lot smaller than Ballast Point, I think there's other options that are better for you, either through private equity or other sources than going public.
Well, and that's probably why we're seeing some of the roll-up strategies start to develop as well. I mean, you know, there's a stated goal for these companies to eventually go public. Is that something that you envision being a successful venture long-term?
Yeah, I think that it's an interesting concept, and I think potentially it could work. And the math probably makes sense for those that are joining together and rolling up, and whether it's through an IPO or some kind of other group investment, you still have to get comfortable with the idea that you may be relinquishing control. You still have to manage brands. Somebody's still got to run the multitude of brewers that are under the umbrella. And making that decision as to if 4 or 5 or 6 really strong brewers all come together to create this kind of craft brew alliance together as a company, who's going to run the brands? Right. Who's going to run the whole company and manage that? So demonstrating that and communicating that to the investor group or whoever's going to come in and buy the stock in that company is going to be paramount.
And Rocky, I'll cut you the check for announcing one of our sponsors afterwards, so thank you. I'm sure it was unintentional, but...
Thank you.
So Ryan, I'll give you the final word. You said a lot of deals coming. How many more can we expect, and for how long?
Yeah, I mean, there's certainly more coming. It's hard to gauge whether next year will have more deals than this year or less. I mean, I think there is a little bit of hangover for the 2 biggest brewers in the country with their own merger going on. It may slow down their deal pace a little bit, depending how they navigate that. But there's still a lot of private equity interest. There's still some foreign strategic buyers who are interested. So I don't know if we'll see the same exact pace next year, but it'll certainly still be pretty high.
Yeah. Awesome. Guys, really appreciate the time.
Thank you.
Thank you. Round of applause for this crew.